If I had a title for this morning's address, it was going to be China Down but Not Out. I still think there's plenty of reasons to be optimistic about China, even though we're seeing a lot of pessimistic reporting coming out of China. I've long been bullish on the Chinese economy. In fact, I used to describe myself as the Pamplona economist on China. You know, I was running with the bulls. But these days, it's a rather lonely place to be when you're bullish on China. It's certainly true that in recent months, China's economy has shown some marked signs of weakness, and possibly more than what most people had anticipated or expected. This morning, I'd like to just survey the property situation in China with respect to the current slowdown in economic conditions. But what I'd like to do mainly is to spend some time looking at the medium to long-term outlook, because after all, I think that really is the space in which we make business and public policy decisions. And then finally, partly because it's so interesting, even if you don't live in Beijing as I live there, the politics, I think for everyone, is fascinating at present as Xi Jinping proceeds to consolidate his power and control over that vast country. But firstly, to the slowdown, and particularly the slowdown in the property sector in China. Now, this is well underway, as I think everyone realises. In the first 8 months to August this year, property prices in 30 cities that were monitored fell by about 11% compared to 2013. And the fall in property prices is very widespread now across the country. However, the pattern is very uneven. First-tier cities are holding up rather well, and some have shown in the last month or so price rises. First-tier cities are places like Beijing or Shanghai, Guangzhou, Shenzhen. But it's in the second and third-tier cities which have seen a huge expansion in construction in the last 5 or 6 years that there's clearly a very big oversupply, and the market is starting to adjust in response to that. However, if you step back from those sorts of numbers and think about it, China has gone through more than a decade of unprecedented property growth and expansion. I guess one of the problems with that is that people have thought that property was just a one-way bet. And we all know, whether it's property or the renminbi, these assets are not always going to go up in value. But it has drawn a lot of people into the sector by way of investment. The difficulty with property, though, at present is that it's linked in a triangular way with local government and local government's capacity to fund much needed infrastructure and other growth-promoting projects. Most of the local governments in China generate their incomes through property sales, particularly land sales. China has what we're very familiar with in Australia, what we call here vertical fiscal imbalance. That is, the centre takes most of the revenues and distributes very little back to the provinces and municipalities, but they have the bulk of the responsibility for spending and providing infrastructure and so on, and other social services. So there's this great fiscal imbalance, and municipalities and provincial governments are very much on their own trying to fund their government programs, and they tend to do so through tried and true and well understood methods of selling land and developing land. Another aspect to the China property situation, which is probably a bit unique to most other places, is that individuals are not heavily geared themselves. Most people have quite a lot of equity in their property. They tend to have high deposit ratios and tend to borrow from family or friends and usually pay back their loans very quickly, certainly much more quickly than would be the case in Australia or the United States or parts of Europe. Property also for people in China is probably the best investment vehicle. There's only really 3 options for ordinary savings in China, or for ordinary people saving. One is you can put your money in the bank and get negative real interest rates, which isn't particularly attractive. Two, you can punt on the Shanghai or Shenzhen stock exchanges, and although they're having a good run in recent weeks, they tend to be highly volatile markets. And I would think, in fact, the good run on those markets in recent times partly is attributable to the weakness in the property sector. It's the flip side. Or you can invest in property, and many people have 2, 3, 4 properties, and they're quite content to leave them vacant. So we hear a lot about ghost cities and high vacancy rates, and I saw a number the other day saying that perhaps as many as a third of all properties in Beijing are vacant, but you don't see a commensurate downward pressure on prices. So all of this is to say that whilst the property sector is definitely weakening in China and has come off enormously, it is a cyclical trend. It's responding to oversupply, and it's not a crash. There's a tendency to write about this as a crash, which through these linkages that I've just been describing would have a knock-on effect to the wider economy. But there's no doubt that all of this is seeing a much weaker outlook for growth in China than we would have thought at the beginning of the year. The last couple of days have seen a run of rather weak numbers. The manufacturing index is down. It only grew by 6.9% compared to 9% in the previous quarter. Electricity consumption, which is an interesting indicator, a proxy indicator for growth, actually fell in August by 2.2%. Transport, which is another interesting proxy indicator of economic growth in China, it also fell by 4.5% over the 3 months from May to August. So there's enough indicators, I think, to accept that things are slowing down. However, I still think that for this year the growth rate is going to be somewhere above 7%, and that's a growth rate that's more or less within the range of the government's policy objectives. They have already undertaken some mini stimulus activity, and they've got plenty of more that they can do. In the property sector, they have selectively eased controls on regulations on how many properties people can hold and so on. Some 30 cities have removed restrictions on the number of properties that individuals can hold. These were put in some years ago when the bubble was when prices were rising to bubble proportions. A lot of regulatory and administrative measures were used to cool the market. And so that means they can equally step back from those measures and stimulate. So I think growth will be around 7% or a bit more. The interesting thing, though, with that growth rate, and it's an important point I'd like you to bear in mind, is that this is a growth rate coming in an economy which is now the second biggest economy in the world. It's also a 7% plus growth rate off an economic base which is twice as big as it was just 8 years ago. And so the absolute growth in terms of demand, and certainly in terms of demand for Australian commodities and resources and so on, is still very big. And a 7% growth rate of an economy the size of China's today, in terms of absolute economic activity, is probably not much different than it was when China was growing 12% 8 years ago. So people talk about slowdowns, and there is a step down in the growth rate, but there is still a lot of activity and a lot of growth in the economy. And certainly it still offers enormous opportunities for Australian exporters across the range of minerals and minerals, energy and agriculture. But it's more important, as I said at the outset, I think, to look at the medium to long term. And I'd like to share with you why I feel still quite optimistic about the outlook for China in the medium to long term. Whilst growth is weaker, there are still underlying powerful drivers of productivity growth. People are concerned that a big investment over the last 20 years is running out of steam. It's what economists would say, diminishing returns to investment or weaker total factor productivity growth. These are technical terms to say that you're entering a mature phase of economic development, and hence people wonder and speculate whether China's going to hit a Japanese-style equilibrium trap. The difference with China and Japan, though, is when Japan hit its equilibrium trap and went into 20 years of stagnation, its per capita incomes were much, much higher than China's.